Aloha, everyone. Welcome to Hawaii International Real Estate Council's webinar entitled Real Estate and the Foreign Investor. My name is Vernon Chalk, and I'm your 2020 HIREC president. Before we begin, there are a few things that I wanted to note. First, this session will be recorded and will be emailed to you in case you wanted to review this session again. Secondly, if you have any technical issues, please type them in the chat box and our staff will assist you. Lastly, we'll be taking questions and answers from the question and answer box at the end of the presentation because we have two presenters today. And our sponsor today for today's event is, as usual, Guaranteed Rate, Leonard Loventhal. And Leonard, thank you as always for always supporting us. So would you like to say a few words?
Thank you, Vernon.
Yeah.
Good morning, everyone. Nice to be with you. We look forward to the presentation by Brad and Ryan. Before we get to that, I definitely want to thank the group for allowing us to come in and be a part of the presentations. They're always very beneficial to the group and very great content. So with that, I would like to share a screen and put up a very interesting graphic that was provided by DJ. And I'm going to have DJ speak to the graph and to the worksheet that I'm putting up. DJ, why don't you take it away and help us out?
Good morning, everybody. Hope you have a good class today. Just wanted to be really quick, and I know you probably heard this already, but mortgage rates are historically low once again. I've been in this business for 20 years and going all the way back to the 2004-05 era when we had this mad craziness. Haven't seen pretty much anything this low. VA, jumbo loans, conventional loans are in the low 2%. Our conventional loan rates are in the high 2%, so under 3% for a conventional loan. The jumbo rates are still, they were a little bit higher. They went up a little bit after COVID started, but they're really starting to relax as well. And there's also some of the non-conforming loans coming back, the stated income for investors and bank statement loans. So there's a lot of stuff that's happening. A lot of loan programs are coming back for borrowers that were not there before. But the main thing is these low rates. It really gives you a chance to touch with your client base and at least not to, check in with them to make sure they're doing okay, but it may turn into another purchase opportunity. You never know. So I want to thank you for giving us the opportunity to sponsor today. And please give us a call. We'd be more than happy to help your clients out.
Thanks, DJ. Oh, Vernon, I want to add one more thing that one of the things that we noticed in this particular environment is that capacity can be an issue. But for us, we're very fortunate. We have a lot of capacity. So if you're having any issues getting to a loan officer or getting some feedback, please give us a call. We can definitely try to help you in this very busy time. Thank you.
Great.
Back to you, Vernon.
Thank you. Thank you, Leonard and DJ, for your support today. And I also wanted to let you know that if any of you are new to the Hawaii Real Estate Hawaii International Real Estate Council, we're a nonprofit organization that provides global-based education and information to its members. For more information about us and membership, you can go to our website, www.hirec.org. Okay, at this time, I'd like to introduce our speakers. We have two. Brad Konishi, he's a CPA and he's self-employed. He's a self-employed CPA specializing in residential real estate tax and assisting realtors in all areas of bookkeeping and tax compliance, including estimated tax filings, general excise tax, and annual income tax returns. Brad also works with home buyers, home sellers, and landlords to provide tax advice in the following areas: capital gains, 1031 exchanges, HARPTA, FIRPTA, and rental investment properties. This is really critical because we're realtors, we're not tax professionals. So it's always best to rely, on professionals like Brad and Ryan, who will be speaking today. So speaking of Ryan, Brian Wilson is a tax attorney and partner with Cade Schutte LLP. He's also a member of the firm's management committee and the chair of the firm's international practice group. He advises local and mainland as well as international clients on a worldwide range of federal and Hawaii tax issues. His particular expertise is in tax treatment of real estate, investment, leasing, and development. He also handles federal and Hawaii tax audits, as well as Section 1031 like-kind exchange transactions. You know, there's really important to have a good licensed CPA and tax attorney, because when you do 1031 exchanges, I've experienced that if you hire a professional, they will not only advise you, but if you're ever audited, and Ryan and Brad, you can correct me, that you will step in and represent the client if there's any question, right? Yeah. Whereas if you go the quick and simple way, and this is not to condone any of the escrow companies that have the exchange programs, you do not get that service. Yeah. So there's a big difference, and I, as a professional, always feel it's worth paying extra for the advice and then be able to sleep at night at the end of it all. So with no further ado, I would like to introduce Ryan Wilson to speak first, and then Brad will follow, and then question and answers will follow from there. Thank you.
Thanks, everyone. Thanks for having me. So I'm going to speak first on tax issues for foreign buyers, and then Brad will speak as to tax issues for foreign sellers. So let's see if I can get my thing queued up here. Okay, it's always an adventure with this stuff. So here's my presentation. Hopefully you see it. If not, let me know. So tax issues for foreign buyers, a quick disclosure, you know, this is just general information. Don't rely on this as tax advice for any particular client. So just getting right into it. So what's a foreign buyer for purposes of my presentation here? A foreign buyer, the technical term is a non-resident alien. That's the term under, you know, for federal income tax purposes. And basically a non-resident alien is someone who's not a U.S. citizen, not a U.S. green card holder, and someone who does not have substantial presence in the U.S. Substantial presence, it's sort of a complicated calculation, but the gist of it is, as long as the foreign person is in the U.S. for less than 120 days a year, they're not gonna have substantial presence here. So that's a foreign buyer for our purposes. If you have someone who's living overseas, but they're a citizen or they're a green card holder, or, you know, they just spend a lot of time in the U.S., they're not going to be considered a foreign person for U.S. tax purposes. They're going to be considered a U.S. person for tax purposes. And those, you know, a U.S. person with overseas ties has all kinds of other horrible tax problems, just not the horrible tax problems we're going to talk about in this presentation. So that's a foreign buyer. And, you know, if you have someone who's a non-resident alien for federal purposes, they're almost always going to be a non-Hawaii resident for Hawaii tax purposes too. So that's sort of who we're talking about for purposes of this presentation. You know, there's all different kind of ways a foreign person could buy and hold real estate. And so I'm going to run through just several of these. You know, the truth is there's only about 2 or 3 of these I would ever actually recommend. But I think it's important just to talk through them quickly so you have a sense of what the tax issues are. So first, direct ownership by individual. I have to apologize. This is my illustration skills are not very good. But what I'm trying to show here, hopefully it's helpful, is we have a obviously very happy foreign individual, and they own Hawaii real estate directly, and, you know, in his or her own name. And what are the tax consequences of that? And short answer is there's a bunch of problems with that. I mean, first is the estate tax. You know, a U.S. person, U.S. citizen or resident, has all kinds of real generous exemptions for estate tax purposes. You know, it's like $10 or $11 million that you can give away at your death without any estate tax at all if you're a U.S. person. For a foreign person, though, it's a big problem because they don't have these big exemptions. They have a very small, it's like $60,000 of U.S. property they can give away without triggering these taxes. But, you know, between U.S. and Hawaii estate tax rates, it's more than 50% of the value. And so you can imagine a situation, you've got a non-U.S. person comes in today, closes on a home, call it $3 million. Tomorrow they die. And all of a sudden that person's estate is going to owe $1.5 million to the federal and Hawaii government. So potentially that's a very big problem. Gift tax is often an issue. I see non-U.S. persons, they buy stuff in their own name and they just decide, well, I'm just going to change title and put my son on title. But that's going to trigger a gift tax. There's no Hawaii gift tax, but the federal gift tax is up to 40% of the value. We're not even talking about gain, we're talking about gross value. So that's a big problem too. Filing tax returns in the U.S., if the foreign person starts renting out the property, they're going to have to file U.S. tax returns. That's not the end of the world. I mean, if there's income generated, someone's going to have to file a tax return. But I often see foreign individuals, they don't really want to have to file U.S. tax returns in their own individual name. The other thing you got to be careful of is a general rule is a foreign person is supposed to pay tax on their gross rental income. So without all these expenses taken into account. Now they can get to the point of being taxed on their net income, so just their profit if they make an election on their tax return, but they have to make the election. And I'm dealing with a problem now. This foreign person started renting it out, never made the election, and now it's too late. And then so how do you deal with that kind of stuff? So tax return filing issues are a problem. And then FIRPTA and HARPTA, if a foreign person sells, and Brad's going to talk about this some more, but FIRPTA and HARPTA can be a problem when a foreign person sells the property. So here are problems: estate tax, gift tax, filing tax returns, FIRPTA and HARPTA withholding on sale. So all of those are a problem when you have an individual owning the property directly. So what if our happy foreign individual, what if he forms a Hawaii LLC and acquires the home through a single member LLC? Short answer is he's in the same position. Generally, single member LLCs, unless they make a special election to be taxed as a corporation, single member LLCs are totally ignored for estate tax purposes, gift tax purposes, and income tax purposes. So even if a foreign person sets up an LLC, it's not going to help them tax-wise. There might be a liability reason to do it, but there's no tax reason to do it. They're still going to have that same estate tax problem and all those other problems I just mentioned. So what about we have an LLC and we've got two foreign members in the LLC and they buy the property that way. These could, this could be husband and wife, it could be parent and child, it could be just friends or business associates. Does that do them any good? Short answer is not really. I mean, still, the U.S. and Hawaii estate taxes will apply to the LLC interests if they die while holding these interests. So that it doesn't help them there. It probably doesn't help them with the gift taxes either. And actually, the tax filing situation gets much more complicated. You've got a tax return that the LLC has to file. Both foreign individuals have to file the tax returns. Those foreign individuals have to make sure they're making the election I mentioned. If the Hawaii LLC sells the property, it's going to be a Hawaii and U.S. person, so there's not going to be any FIRPTA and HARPTA withholding. But there's going to be, LLC is going to be obligated to withhold on the income allocated to the members. So you get out of FIRPTA and HARPTA technically, but you've really just shifted the withholding obligation to the LLC. So you really haven't accomplished anything by doing this either. So I'm sorry I'm being such a downer on this stuff. So next possibility is, what if we set up, the foreign person sets up a Hawaii corporation and then the corporation buys the property? Where does that get us? Well, in terms of Hawaii and U.S. federal estate taxes, it doesn't get us much of anywhere. Those estate taxes will still apply to the corporate stock, a stock of a U.S. Hawaii corporation, if that foreign person dies while they hold the stock. So it doesn't help us there. Interestingly, though, the foreign person could give away the corporate stock without triggering a gift tax. So it does get us around that problem. So that's good. in terms of the tax filing, the corporation itself would have to, and if it's earning some kind of rental or other income, the corporation is going to have to file U.S. and Hawaii income tax returns. No way around that, but the shareholder personally generally won't have to file tax returns. So that's an advantage. And then lastly here, because it would be a U.S. corporation selling the property, there'll be no FIRPTA and HARPTA applicable to the sale. So that's an advantage. So, we haven't solved the estate tax problem with this. We've made the tax filing easier. We've gotten around the FIRPTA and HARPTA. There's some gift tax benefits. So that's better than those other things we just discussed. I think what you have to keep in mind though is putting something in a corporation sort of builds in a double tax potentially on the property. So what I'm talking about is, so you're going to have property held by the corporation. If the corporation rents out the property, the corporation is going to pay income tax on that rental income. And then if it distributes that money to the shareholder, that would be taxable to the shareholder. Now, if it's sort of, operating dividends, as the corporation is still in existence, that's probably going to be subject to a withholding tax on dividends in the U.S. If the corporation is liquidated, there's going to be a corporate level tax if it sells the property, right? If it then distributes the money, that distribution of the money may avoid tax in the U.S., but it's probably going to be taxable in the foreign country. So this structure, holding it through a corporation, it's not a home run exactly. And it wouldn't be my plan A for advising a client, but it might be the best you can do if the person closed on the property in their individual name and they start worrying about estate taxes and other things. Another possibility is the foreign person forms a foreign corporation, a non-U.S. corporation to hold the property. Now, this will get you out of estate and gift taxes because the stock of a foreign corporation is not subject to estate and gift taxes in the U.S. The corporation would have to file tax returns for any rental income, sale income it has. It's going to have to, like I said, make sure it makes the special excellent to be taxed on net income. The shareholder will generally not have to file tax returns. So, we're in a better position than we were in some of those other structures. But you're back to being subject to FIRPTA and probably HARPTA on the sale of the property because you have a foreign corporation selling property, right? The other problem is if you have a foreign corporation that's generating rental income in the U.S., you can also trigger what's called a branch profits tax. And that's essentially a tax on deemed dividends of the rental income, back to the home country. The problem with this is it's worse than a regular dividend in a lot of cases because a regular dividend, you can control the timing of it. This branch profits tax on foreign corporations operating directly in the U.S., it's even if the money is not repatriated, this tax could be triggered. So it can mess up the client from a timing point of view. So I generally don't recommend this idea either. So do I have any ideas for you that might work? So this is something that tends to be more promising. So we have the foreign person, they form a non-U.S. corporation, a foreign corporation. That foreign corporation sets up a Hawaii corporation. That Hawaii corporation is the one that buys the property. And where does that get us? Well, first, this completely gets us out of the estate and gift taxes because the foreign person is holding foreign corporation, and that's not subject to estate and gift taxes. In terms of tax filing, it's the Hawaii corporation that would be earning the U.S. source income from rental or sales, and so the Hawaii corporation would file the tax returns. The foreign corporation wouldn't have to worry about it, and the shareholder wouldn't have to worry about it. So we're good there too. And in terms of FIRPTA and HARPTA, there wouldn't be any on the sale of the property because you've got a Hawaii corporation, which is a Hawaii entity selling the property. FIRPTA and HARPTA are not an issue. So this solves a lot of those problems we were just talking about, right? So this tends to work, I think, for a lot of foreign buyers. It's not totally tax-free because, like I mentioned, you put something in a corporation, there's going to be a second layer of tax to pay somewhere down the line. The good news though is, you know, when you repatriate the money from a wholly owned corporation to its parent, a lot of times there's lower withholding rates, lower rates of tax when that happens. So you got to structure this properly, but you'll often find that by setting it up this way, you can get the money back from the U.S. company to the parent without paying the second layer of tax. And that second layer of tax will be in there still. And so probably when the foreign person, if they want to get it out of the foreign corporation and use it for personal purposes, it will be lurking there at some point. But I tend to find this, you know, most foreign buyers tend to be comfortable with that idea. If you're going to do this, just a general note, you should have each U.S. property in a separate U.S. sub for the client. You know, that structure I just talked about, that two-tier structure, it works pretty well. The times I start to worry about it is when, if there's a lot of significant personal use of the Hawaii property by the foreign person, I start to worry that maybe it's not appropriate for a corporation to be holding it. There could be some sort of imputed income somewhere. And that kind of situation, this structure shown here might work a little bit better. Here we got the foreign person owns 1% of the Hawaii LLC directly. The other 99% is held by a foreign corporation that the foreign person owns 100% of. And this, it minimizes, doesn't totally eliminate, but minimizes the U.S. estate and gift taxes, because those taxes would apply only to the 1% interest held by the foreign person directly. It wouldn't apply to the other 99%. It avoids FIRPTA and HARPTA because a sale of the property would be by a Hawaii LLC, you know, multi-member LLC. So we don't have FIRPTA and HARPTA there. Tax filing is complicated. The LLC has to file partnership returns. The foreign person has to file tax returns in the U.S. The corporation is going to have to file tax returns in the U.S. You know, they got to make those elections I talked about. There's withholding. The LLC has to worry about on income to the foreign people. So it's complicated, but it may work a little better if you have a situation where the foreign person or his relatives or something are making significant personal use of the property. This is something that could be considered and something I have used in the past. Last, trust. This is a lousy depiction of a trust. You know, trusts have trustees and beneficiaries and stuff. I don't have a whole lot to say about trusts. I mean, trusts are definitely important. They have a place and a good use when you're talking about foreign people immigrating into the United States, the tax planning idea there. But when we're just talking about this situation where it's a foreign person buying a house or something, I tend to find that they don't work very well. One of the reasons is because trusts, you know, they involve giving away ownership rights to the property. And I'll mention this to a foreign buyer and they say, well, I don't want to give up ownership rights to the property. I want to buy this because I want to use it myself, you know. So for that reason, there's problems with it. You know, it's got to be set up ahead of time before the property is even purchased. Otherwise, you know, you're get back into the gift problem. You know, a lot of foreign countries don't even recognize trusts. I was working with a client, it's a U.S. citizen in Germany, who has some different kind of tax problems. But I recommended to her, well, if you set up a trust, maybe you don't have a problem in the U.S. And she tells me trusts aren't even recognized in Germany at all. You know, all the income is going to be taxed directly to the beneficiaries or somebody. So there's difficulties like that. And then, you know, foreign trusts, they're still going to be subject to FIRPTA and HARPTA, and there's all kinds of other taxes you got to worry about. So trusts I generally don't try to use in this context. Just a last note here. I threw a lot at you here, but I hope you at least can see that you know, there's a lot of tax issues, and it's really important to figure this out and think about it ahead of time. Because once you have property in the personal name of a foreign buyer, in their individual name, it can be very hard to get out of it. Like I said, if you know, the foreign person just wants to change title and give it to their relative, that's going to be a gift, and it's going to be taxed up to 40% of its value for U.S. gift tax purposes. So that can be real daunting to try to face that. You know, some of these ideas I talked about for for minimizing tax problems involves getting the property either directly or indirectly into a foreign corporation. But if you start out with the property either in the individual name of the foreign person or in the or even in a U.S. entity, if you try to transfer it from there to a foreign entity, you got to pay taxes on the gain. If that property is appreciated at all, you got to pay taxes on the gain. Between federal and Hawaii, it could be up to almost 48%. So that's a problem. Even if it hasn't appreciated, you got to deal with the FIRPTA and HARPTA, and those could apply. So it can be very hard. You're going to trigger an income tax if you try to get it into a foreign corporation if you haven't done it up front. You can get it from an individual into a U.S. corporation or LLC. That generally won't trigger any gain. You do have to notify the IRS. It's not a huge deal, but you got to do it. And so this goes back to what I said. A U.S. corporation holding structure might not be Plan A, but it could be a Plan B, maybe your next best option if you haven't thought about this and planned appropriately ahead of time. So that's all I got. I'll see if I can get this over to Brad now. Let's see. There. Okay, I think are you free to take over here, Brad?
Shot. Screen share. Yep. Here I go.
Okay.
Okay. Hopefully you can see my slides, everybody. Let's see. So let me thank you so much for that part, Ryan. That's super informative. So let me, Ryan's talking about the implications, the tax implications on the buy side. The host has asked you to start your video. Start my video. Okay. Oh, there we go. Okay. So, so Ryan talked about, some of the tax implications on the buy side, but let me talk to you about some of the tax implications on the sell side. So foreign investors, what happens when they sell? Quick disclaimer, the following information is not tax advice, presented for discussion purposes only. See a qualified tax professional for tax advice, and whatever you do, don't give tax advice to your clients. So let's first talk about FIRPTA. FIRPTA, of course, the withholding rates are anywhere from 0 to 15%. FIRPTA stands for the Foreign Real Property Tax Act, and it's a withholding that's done on the disposition on the interest of real property. So if the home is equal to or less than $300,000 and the buyer plans to live in the home, the rate can be as low as 0%. If a buyer commits to use the home as a personal residence and is selling for more than 300, but less than $1 million, the FIRPTA rate is 10%. And for all other circumstances, if the home is over $1 million, or if the buyer doesn't want to commit to use the home as a personal residence, then the rate is going to be 15%. So, who is a foreign person? The IRC, which is the Internal Revenue Code, says the FIRPTA applies to a foreign person. So a foreign person is a non-resident alien individual, foreign corporation that has not made an election under this thing. But what it comes down to basically is a foreign person is a foreign corporation, foreign partnership, foreign trust, foreign estate. It does not include resident alien individuals. So what is a resident alien individual? Somebody who passes what's called the green card test. To keep a green card, you must not make your primary home in any other country, nor remain outside the US for more than a year. Substantial presence test, you have to be substantially present in the United States. Even without having a green card, a person who spends 31 days in the US during the current year and 183 days during the 3-year period that includes the current year and the prior 2 years is considered to be a resident alien. So even without a green card, you might be able to get considered to be a resident alien. So how is a foreign person taxed on the sale of Hawaii real property? Well, if you're a resident alien, you're taxed on your worldwide income, and you're taxed like a US citizen. US citizens are taxed on their worldwide income as well. However, non-resident alien is a little bit different. A non-resident alien is only taxed on US derived sources. and the income has to be effectively connected with a with a business that's based in the United States. Things like salary and compensation. U.S. investment income is generally taxed at a flat 30% rate unless the U.S. has a tax treaty, like it does with certain foreign countries, to allow for reduced rates. Let me discuss some of the logistical issues that are related to COVID-19 and also to travel restrictions, because that has increasingly played a more important role in some of the filings that we do. The IRS has not been processing paper filings for several months, and they only recently restarted their operations. So there's this humongous backlog. There are substantial wait times for paper filings to be processed at the time and processed by the IRS. And these include things like W-7 applications, which are the applications that foreign individuals need to receive an ITIN, which is an individual taxpayer identification number. And also to the 8288B FIRPTA filings. These are the FIRPTA filings that we send to the IRS in order to obtain some kind of judgment by the IRS as to how much we can send to the IRS and how much we can return to the owner of the real property. So let me talk to you about a situation that happened recently that kind of explains some of the logistical challenges that people are having, as it relates to COVID and travel restrictions. Actually, it's funny. The person that I deal with on this is Laurie Murphy, and she's on this call right now. But anyway, we're not going to name the clients, but we're going to talk about the clients. They were sisters, and the sisters had dual citizenship, the United States and also the country that they resided in, which is New Caledonia. Sometimes you need a notarized signature. However, the U.S. generally does not accept foreign notarizations. The seller has to go to a U.S. embassy to receive a notarization, generally speaking. So many U.S. embassies around the world are closed or have strict limitations on visitors. So, that possibility is out if somebody needs a notary. And then, there's a situation where, well, what if they get on a plane, they fly to the U.S. and they get it notarized by somebody in the U.S.? Well, some foreigners are really hesitant to get on a plane and fly to the U.S. because they may experience difficulties getting back home again. It's a real concern. So let me jump to HARPTA now. HARPTA stands for the Hawaii Real Property Tax Act. It's the Hawaii equivalent of FIRPTA. So the buyer of Hawaii Hawaii real property is required to withhold 7.25% of the amount realized from the seller and pay that amount over to the Department of Taxation. So one thing to keep in mind is if you're representing a buyer, just keep in mind that your client is actually the one on the hook for collecting HARPTA. So it's really important that they understand what their responsibilities are. Sellers who are resident persons are allowed an immediate exemption from the withholding requirements of HARPTA by completing what's called a Form N-289. One thing to keep in mind, and a lot of times when you have clients, because I work with a lot of real estate agents, when you have clients who, who are subject to this, please try to tell them about the withholding, whether it be HARPTA, FIRPTA, or both, before it gets to escrow, because if they find out from the escrow officer, they're probably going to hit the roof. If you tell them beforehand, they can kind of mentally get prepared for it. So, and also to let them know that HARPTA and FIRPTA are withholdings. HARPTA and FIRPTA are not taxes in and of it themselves. So a withholding is an amount held by the government in anticipation of possible future taxes. If a withholding exceeds the amount of the actual tax liability, the taxpayer is entitled to a refund. So one of the things you hear a lot, Hawaii is just a horrible place for taxes. A lot of times I hear from people, Hawaii is the only state that does these sort of withholdings on the sale of real property. It's not true. There are actually 16 U.S. states that currently withhold on real estate sales. Some of them do it based on gain. Some of them do it based on gross sales price, like Hawaii does. But Hawaii isn't the only one. So there's really 4 ways to deal with HARPTA. Actually, there's a 5th way, and I'll talk about that in a second. But dealing with HARPTA, before closing, you can do it with the N-289. The N-289 allows you to get a complete waiver of HARPTA immediately if you're a resident. The second option would be is if you're participating in some kind of non-recognition provision, such as a 1031 exchange. It also may be possible to get an immediate waiver of HARPTA, you know, even without even having to apply. However, if on the N-289, the third option would be if you're selling a home for less than $300,000 and the seller has used the home as their main home within the last year. You know, it's also possible to get a waiver of HARPTA by applying for it via a withholding certificate. A withholding certificate is essentially a HARPTA waiver. It allows you know, the home seller to get HARPTA reduced or waived. After closing, you can you know, deal with HARPTA by getting an early tentative refund by applying for it, or you could file a Hawaii income tax return. Just, you know, wait until the following year and then file a Hawaii income tax return. Of course, you know, especially if you're selling, say, in the first half of the year, you're going to have to wait a long time, right, before you file your Hawaii income tax return. So a lot of people who are selling earlier in the year tend to want to get their refund back a little sooner so they can apply for it, getting an early tentative refund. So once again, this is the N-289. When you're, if you're representing a seller and they go into contract, the seller will receive this N-289. Resident person, is the home seller a resident person? They get an immediate exemption from HARPTA. Non-recognition provisions, like 1031 exchanges. Residence and sale price threshold, if it's less than $300,000 and the seller used that as a principal residence in the last year. So who is a resident person? For HARPTA purposes, who is a resident person? It's a person who is domiciled in Hawaii or anyone who resides in Hawaii for anything other than temporary or transitory purposes. So domicile is an interesting word. What is a domicile? A domicile, and this is taken directly from the Hawaii definitions of residency. A domicile is the place of the individual's true, fixed, permanent home and principal establishment, and to which place the individual has the intention of returning whenever the individual is absent. So a person may have multiple residences, but they can only have one domicile. Although intention is a key factor in determining domicile, you know, if the person ever gets audited, it must generally be, you know, supported by evidence. And every once in a while, you know, I talk to people, you know, when I explain the residency requirements and I talk about domicile, you know, every once in a while I hear somebody say, well, you know, I'm selling my home in Hawaii. You know, I got a job on the mainland, moving to the mainland, but, you know, my one true home is Hawaii, and I intend to eventually return back here, you know, after all of this is over, whatever it may be, you know. So one of the things I usually ask is, well, you know, of course it depends on the facts and circumstances surrounding your particular situation, but picture it from the auditor's standpoint. You know, somebody is saying, well, you know, Hawaii is my one true home. You know, I live here, you know, I lived here for a while and I plan to come back here. You know, is it really, right? I guess one of the questions that would, if I were the auditor, that I would ask, one of the first questions would be, well, if Hawaii is your one true home, why are you selling the only residence you have in the state that you intend to return to? You know, I mean, there might be reasons why, you know, so a person's residence or a person's domicile really should be supported by other evidence other than just saying, well, yeah, that's my one true home. You can also establish residency by physical presence. Physically present in Hawaii for anything other than temporary or transitory purposes, you might be considered to be a resident. There is what's called a safe harbor. If you are in Hawaii for 200 or more days in the taxable year, you have a safe harbor. That doesn't mean that you're automatically a resident as a result of being physically present, you know, for 200 days. All that means, generally speaking, is that the burden of proof switches from you back to the state or the auditor or whoever's representing you know, the state's interests on that side. An individual status as a resident or non-resident shall not change solely because of the individual's presence or absence in compliance with military or naval orders in the, of the United States while engaged in aviation or navigation or while a student at any institution of learning. So, and this is interesting. You know, if you have dealt with military clients before, you may be aware that if somebody signs up for the military, they have actually they can choose what is, well, their home state is usually the state in which they enlisted, and they can choose. Generally, they usually choose their home state as their state of legal residency. If they say register for the military in, say, Texas, for instance, and they choose Texas as their state of legal residency, Texas has a requirement that doesn't require the payment of state income taxes. So even if that person gets PCS, you know, to Hawaii, that person is not really a Hawaii resident for HARPTA purposes. So just kind of keep that in mind. Yeah, I have actually a HARPTA flowchart, and you can take a look at this. You can see this in the recording. Hopefully you can see this clearly. But one of the first questions, of course, is the person a resident seller? Second question would be, is there a non-recognition provision, like say a 1031 exchange? Or has the seller used this as their principal residence for the last year and the sale is less than $300,000? Well, they might be able to get an immediate exclusion via a N-289, which they obtained from escrow. One of the things to keep in mind, caveat, in order to get a withholding certificate or any sort of refund at all, the client must be current with all of their tax filings. They will hold your HARPTA money hostage until, until you come current with your tax filings. So not so much, it's not so bad if somebody, say an international buyer owns a Hawaii home that they use for their second home, which tends to be, the case more often than not. Then because it's not a income producing property, there aren't really as many requirements. Well, there aren't any requirements really if it's just a second home for you to file Hawaii income tax returns or for you to file GE tax returns because it's not really generating any income, right? However, if it's a rental, they have to make sure they're current with all of their Hawaii income tax filings as well as their GET and possibly TAT if that applies. So got to make sure current with all of the tax filings. Before closing, there are a couple of options, right? If you can't get an immediate exclusion from HARPTA via the N-289, there are a couple of ways to apply for, a waiver of HARPTA. And the first situation is if the person is selling a home at a tax loss. If we can prove to the state of Hawaii that the home is being sold at a loss, Hawaii is actually obligated to waive the HARPTA requirements. If, and this is a subtle difference, if the seller is not going to recognize a gain, so if they have a situation where, yeah, military stationed in Hawaii, Section 121 gain exclusion might apply. Or here's a third situation. If the seller has insufficient equity in a property and is required to bring cash to closing, they can get a reduction of the amount withheld for HARPTA purposes. And this is, this happens from time to time, right? Somebody maybe has just purchased and then they're turning around and selling really quickly, so they haven't had time to build up equity. Or maybe they borrowed against the property and, all of a sudden they don't have that much equity. So if they go into closing, they need to bring cash to closing. Well, the state doesn't want to be the bad guy, to kind of stand in the way of this transaction happening. So a lot of times they'll, allow for a reduction of HARPTA. If you want a HARPTA reduction or a HARPTA waiver and you need to apply for it, just keep in mind that getting a withholding certificate, the timing is that you have to apply no later than 10 business days prior to closing. So keep that in mind. That deadline is pretty strict. They're pretty strict about that. If there's no withholding certificate, if you can't get a HARPTA waiver or reduction, don't worry, because after closing, investor, even a foreign investor, can apply for what's called an early tentative refund. they can usually receive their refund in 8 to 16 weeks after applying for it. You know, super attractive, of course, if you're selling the first half of the year, and even, you know, July, August, September, maybe. But, you know, once you start getting towards the end of the year, it might just make more sense to wait until the following year and apply for the refund with your tax return. So once again, after closing, you can also file, you know, with your tax return. And even if you do get a HARPTA waiver or early refund, or you know, a situation similar to that, you still have to file a Hawaii income tax return. You know, it's not as if, oh, okay, I got my refund or I got my waiver, I'll disappear. You still got to file the Hawaii tax return. Sometimes sellers can wait to get their tax refund. They may have to wait as long as a year, sometimes even more. You know, I'm currently working on a situation with the IRS it seems that the state is a lot better about returning money on a timely basis than the federal government. Sometimes, you know, a FIRPTA 8288B bounces from department to department and it's hard to track down. And that's it. If anybody has any questions for me, let me go ahead and stop share. Or if you have clients that have questions about HARPTA or FIRPTA, they can go to harpta.com, it's my website. So let's see. Copy of slides. You know what I'll do is I'll make a Google a link to it, and then I'll send it over to Crystal. Maybe Crystal can point that out.
Sure, no problem. So we have a couple of questions,
okay.
And the first question that came in, and I believe it came in early on when Ryan was speaking, is someone who has an outstanding scientist visa, who owns Hawaii real estate, who has lived in the U.S. full-time for over 20 years and filed U.S. and Hawaii state taxes, are they still considered foreign?
No, if they're living in the U.S., they're considered a U.S. person. So good news about that is, you know, if they sell property, they're not going to have FIRPTA or HARPTA withholding. Bad news about that is, you know, they're subject to, you know, tax on their worldwide income. You know, so if they've got income in Sweden, they better be paying tax on that. If they're not, they could have a problem. If they've got foreign assets in foreign countries, they should have been reporting those on their tax returns. If they haven't been, they have a problem. But to answer the question, if they're living in the U.S., they're definitely a U.S. resident.
Okay. Next question. Can a foreign buyer vest a property in a Hawaii trust to avoid such taxes?
Yeah, maybe. I mean, it's got to be set up ahead of time. That's the first point. If you try to set up a trust after you've already acquired the property, you're going to have gift tax problems. Like I said, once I start talking to clients about it, they tend to not want to do it because you're usually having to give up some kind of ownership rights to the property. You're gifting it to the trust, and there's other beneficiaries and stuff. So it might be possible. I just think the practicalities of it make it not so attractive to most foreign buyers.
Okay. Next question. What determines foreign corporation or LLC?
Well, okay, so an LLC, they're kind of weird. So the general rule is an LLC, if it doesn't make any kind of special election, if an LLC has one member, it's totally ignored for income tax purposes and for estate tax purposes and gift tax purposes. So you got a single member LLC, it's ignored. It has to file its own GET returns and stuff, but for most federal tax purposes, it's totally ignored. If you have an LLC with two members and it doesn't make any kind of special election, it's taxed like a partnership. But LLCs can elect to be taxed as corporations. And if you have an LLC that elects to be taxed as a corporation, it'll be taxed just like a corporation, no matter how many members it has. You know, there's situations too where you can, you know, LLC can elect to be taxed as a C corporation, then go on and elect to be taxed as an S corporation. That's not going to happen with, you know, foreign shareholder, but that's the rule for LLCs. Otherwise, you know, it's going to be a matter of you know, what kind of entity you form with the DCCA. You forming an LLC, or are you filing a corporation with the DCCA? So hopefully that answers the question.
Okay. This is a pretty long one, so I may even ask the person who's asking the question to clarify, but it says, some escrow companies do not give buyer any HARPTA, FIRPTA withholding in full until closing, buried in a pile of documents sent to buyer for signature at closing. Approve and sign this. Withholding is required per P1 and P2 of purchase contract if certifications of exemptions were not delivered to buyer 14 days prior to closing, but this frequently does not happen. What should buyer's agent advise buyer to do and when to satisfy buyer's withholding requirement?
I'll go ahead and take that one. I can see why the 14-day requirement prior to closing doesn't work, because you know, a lot of times, you know, we're waiting for the state to make a decision, you know, to apply for a HARPTA waiver and such. What would we apply? I would advise that if you're a buyer's agent, number one, that you make sure that you exercise due diligence. You know, if you have a situation where you believe that the Hawaii or the person selling, the seller is not a Hawaii resident, ask questions. You know, if the person is in the military, maybe even ask for a requirement or you know, ask for, you know, some kind of evidence that the person declares Hawaii is their state of legal residency. And if they don't, let them know that, you know, we're gonna demand that you know, HARPTA you know, applies. When it comes to the 14 days, I would say, you know, maybe see if there's some kind of room for flexibility, because you know, the 14 days prior to closing, yeah, it's not really realistic for it to happen in most cases. So that would be my general advice. Okay.
Another question here says, when would a foreign person pay taxes doing a 1031 exchange? Per your statement, they may not avoid it if they put it in a trust. So will they ever avoid taxes?
Well, if a foreign person is doing a 1031, they can exchange U.S. property for any other kind of U.S. property under 1031. If they're doing a 1031, they can, you know, just provide, as Brad mentioned, that N-289 and claim the, you know, and just claim an exemption from it. FIRPTA is going to be a bigger problem. I think in order, even if you're doing a 1031, you have to apply, you know, for a withholding certificate with the IRS, and it takes quite a long time. And I think with deferred exchanges, it's sort of difficult to get. So a foreign person, they can do a 1031 and they don't have to pay taxes immediately on that. But probably because of the FIRPTA, they're going to have to front that money into the exchange and then try to get a refund of it after the fact.
Okay. Now, I know that in our earlier conversations, Brad, that we talked about a Senate bill that you wanted to mention. Can you briefly go over what that Senate bill is about?
You know, I don't know the details of the Senate bill, but it's shocking when I first saw that it actually made its way out of committee. But it's a bill that disallows foreign ownership by of Hawaii real estate, and yeah, you know, I have to claim ignorance about that bill. I got to learn more about it though, because it's going to have a huge effect on my business. But yeah, it's something that was kind of shocking. It's not law yet, but
well, you know, what I can do for those of you who are in this webinar is I can pull a link to the bill so that the members are well aware of what it is, and I did briefly go over it yesterday as well. So we'll when I send out the link to the recording of this session, hopefully the link to the PowerPoints and whatnot, I'll also include a link to the bill as well, so that our members know what's happening and what's moving. so that everybody will be well informed. Well, that's all I have as far as questions. Let me just double check and make sure I got everything. Oh no, I got a few
question
more.
for Stephen Zane.
I think it's 3110. Okay, a couple more questions, guys. Can we do that?
I got it. Yeah, sure. I'll take this one. I see this question from Stephen Zane. Are out-of-state trusts subject to HARPTA? Generally speaking, yes. It depends, of course, what exactly you mean by out-of-state, but yeah, it may be possible that it may be subject to HARPTA. The question also too mentions the stepped-up basis should cover most, if not all, taxes. And I think I should just briefly explain what a stepped-up basis is. What happens is if somebody is holding real property when they pass away, what happens is the basis gets stepped up to fair market value as of the date of death, or in some cases 6 months from the date of death. But the beneficiary in many cases can sell that property right away, and they wouldn't have any income tax because the basis is stepped up and there's no gain on the sale. So yeah, I don't know. I don't think there's a basis step up so much with foreign persons though, right? Isn't that true, Ryan?
Well, I assume if they had U.S. property, they would get stepped up. I think it's nasty. They got to pay a nasty estate tax.
Oh yeah.
Stepped up if it was subject to estate taxes. Yeah. If it was some off-site property, I guess we wouldn't have to worry about it.
Okay. All right.
We have two more questions. Foreign seller with no gain still needs withholding for FIRPTA and HARPTA?
Possibly. Possibly. What you need to do is, at least with HARPTA, you need to prove to the state of Hawaii that there was no gain. So, one of the ways we do it is by showing them documents. You show the final settlement statement from the purchase. You show any kind of invoices from improvements that you've made to it, and then you show the estimated seller statement. And if you can prove with all those documents that the seller has no gain, then you can get a HARPTA withholding certificate that would exempt them, from HARPTA withholding. For FIRPTA, it's a little bit different. There's a form called the 8288B, and what happens is you fill out that form, you submit it to the IRS. In a perfect world, what happens is the escrow company or a company that is, marked as a withholding agent will hold on to the FIRPTA money until the IRS makes a determination if that person is going to receive back some of their FIRPTA withholdings. And once that determination is met and sent to the withholding agent, then the withholding agent sends some of the money to the IRS and then some of the money back to the home seller. So if you have no gain, the home seller might get back all of their money. So it is, FIRPTA is going to be, I guess you could say FIRPTA will probably be withheld. HARPTA, you can probably apply for a withholding certificate and get it.
And can I weigh in? There was that previous question about what determines, I'm sorry, I'm changing topics here, but what determines foreign corporation versus LLC? And maybe I misunderstood the question, but generally, if a corporation is formed under U.S. law, it's going to be a U.S. corporation. If it's formed under some kind of foreign law, if it's a Japan corporation, a Singapore corporation, a Cayman Islands corporation, that's a foreign corporation, right? So it depends on the laws under which it's been organized. So sorry if I misunderstood that question initially.
Thank you, Ryan. We have time for one more question, and that is an appraisal required to determine the stepped up basis?
I'll take that one. What I've done in the past is sometimes if there's no appraisal done for a stepped up basis and somebody is applying for a HARPTA withholding certificate, I've done several things before. I've put in copies of the most recent property tax, Honolulu property tax valuation, and used that as what the fair market value is at the time. It's passed before. I can't say that if they're always allow that, but that has been allowable before. In a couple of cases, we didn't have an appraisal. you know, we used, you know, the city and county tax valuation. Once we did have a reviewer who questioned that, but we, you know, one of the things we did show is, well, you know, the deceased passed away, you know, just a couple of months before the sale occurred. How can you make the case that there was a substantial increase in the value of the property in just a couple of months, you know? And at that point, the reviewer kind of acquiesced. And so I don't know if you necessarily need an appraisal, but it certainly does help.
Oh, thank you. Thank you so much. Hey, I want to thank Brad Konishi and Ryan Wilson one more time. Virtual clap for them. Thank you so much for sharing with us today. And I also wanted to thank Leonard Loventhal and DJ Dole, our sponsors for today, Guaranteed Rate. We so appreciate your support at almost all our events. Our next HIREC virtual GMM will be featuring David Garfield, an attorney with Garfield Law Group. He'll be doing a webinar entitled Immigration Strategies for Foreign Real Estate Investors. That's on September 14th at 10 a.m. and I'll be sending out that registration link as well. So be healthy, stay safe, everybody, and mahalo for being here today.
Thank you, everybody.
Thank you.